Thanks for clicking! All eyes were on the Bank of Canada this morning, with most onlookers expecting the bank to cut interest rates by 50 basis points, and some, such as CIBC, expecting the bank to go 75.
500!
We got our answer at 9:45 this morning when the bank did in fact go 50 basis points, bringing the policy rate down to 3.75. And Bank of Canada Governor Tiff Macklem and Deputy Governor Carolyn Rogers held a press conference shortly after the interest rate announcement, where the towering intellects that are Canadian media hit the governor with the pressing questions of the day.
Wondering how likely you think it is that you'll have to cut by another 50 basis points in December.
Look, I'm not gonna handicap the next move.
That was the third time the governor was asked about rate cuts that conference, and if you're keeping count, the 34th of this year. But we did get some decent questions, and others, at the conference, with the governor being asked whether or not these new mortgage rules would have an effect on the Bank of Canada's thinking, as well as the impact of U.S. bond yields on Canada's policy rate.
Does that matter?
So what I want to do today is go over the Bank of Canada's announcement, take a look at the press conference held shortly thereafter, and then discuss some implications. As we'll see today, it does look like the Bank of Canada is going to be cutting rates further, though some uncertainties remain, but we'll obviously continue to track the bank's policy on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this announcement. On to the announcement. As mentioned, the bank cut interest rates this morning by 50 basis points, bringing the policy rate down to 3 3/4.
But everything is going to be different now.
Yeah, speaking of the real estate industry, let's take a look at those 5-year bonds, which remained unchanged following the announcement. In fact, they were up on events occurring out of the United States, meaning no change to fixed mortgage rates. This was actually discussed at the press conference, but we'll get to that later. For now at least, though, to the media, to the usual suspects, to mortgage agents, to bank reps, stop telling people that when the bank cuts rates, fixed mortgage rates are going down. As we've seen today, that's simply not the case.
So you're telling me there's a chance?
But I digress. The bank did note in its statement that it's pleased that inflation continues to come down and does expect to lower rates further. With that said, the bank did note that there are some upside risks to inflation, including the housing market taking off again and wage growth. So if house prices do take off, if we see upward pressure on inflation due to the real estate industry, that could cause the bank to reconsider the cutting of interest rates. With that said, the governor also noted that there are some downside risks to inflation as well. Mainly, that Canadians may not pick up the spending.
This downside risk to inflation is that it could take longer than anticipated for household spending and business investment to pick up.
So, the bank cut rates by 50 basis points, plans on cutting more, but is warning that Canadians, A, could spend too much, or B, may not spend enough.
No.
And then, finally, heading into the conference, the governor tried, unsuccessfully, to head off the obvious questions on rate cuts, letting us know that the bank hasn't decided when and by how much it will be cutting rates in the future.
Timing and pace of further interest rate cuts will depend on incoming information and our assessment of its implications for the inflation outlook.
So, the timing and intensity of rate cuts will be data-driven.
Oh, you throwing too many big words at me.
Yeah, that didn't stop Canada's media elite from pushing the governor.
How fast do you think that the monetary policy, the policy rate should move back to a place where it is no more restrictive?
Which, of course, the governor didn't answer, repeating himself for about 3 or 4 minutes before finally stating that the bank's decisions will be data-driven.
We're going to get the third quarter national accounts. We're going to get a couple of employment reports. We're going to get a CPI release. So we'll be looking at all that data as well as any other information we receive between now and then, and we'll take our decision in December.
And then, of course, why didn't we get 75?
Was there any discussion of an even larger cut, given that rates are still restrictive, inflation is back on target, and you want growth to pick up?
Now, stay with me. Remember when the bank was cutting by 25 basis points and the media continued to ask why they didn't cut by 50? And remember when the governor didn't answer? That.
We will continue to watch the data as it comes out relative to our forecast, and we'll take those decisions one at a time.
You know, you can logic this stuff out before you get to the conference.
Really?
And then, finally, for the third rate cut question of the conference and 34th of the year, the governor was asked about future timing on cuts.
Look, I'm not gonna handicap the next move.
So, those three questions taking up about 1/4 of the time of the press conference, all of which were not answered by the governor. And then, in an odd shift, the governor was asked to basically run a monetary policy class, asking the governor why he would not answer these questions.
You're sticking with another, sort of the meeting-to-meeting cadence. I wondered if you could just discuss about why it's so difficult for not only the Bank of Canada, but central banks generally to lay out a clearer trajectory for rates over the next couple of years, and discuss the extent to which that might be weighing on investment decisions going forward, given the lack of clarity around monetary policy.
And then the governor got a little snippy.
Well, Kevin, we actually have been very clear about the direction of policy rate.
What are you, stupid? Huh?
Which, yeah, the governor is not going to lay out what's going to happen over the next few years. Because A, he doesn't know what's going to happen over the next few years, which really should have been known pre-2020, but definitely should have been known post-transitory. And B, anything the governor says is going to be priced into the market, which will obviously affect the future. Basic research method stuff.
Because I don't understand him, I'm going to take him as disrespect.
But then we did actually get some substantial questions, with the governor being asked if the bank was concerned that these new mortgage rules coming down from Ottawa would push up house prices.
Housing, you cited it as a main sort of risk to the outlook. You cited new mortgage rules introduced by the federal government, pent-up demand, and lower interest rates. Can you expand on how you're weighing those worries in your deliberations?
The governor passed the question on to the deputy governor, who, for her part, said that it could go either way.
It is possible that the combination of lower interest rates and changes in mortgage rules could mean that pickup happens sooner or faster or is stronger than we expect. It's also possible people will look at the direction of interest rates and sort of stay on the sidelines a bit longer and wait for rates to come down more, and we don't see that pickup happen as fast or as strong as we're anticipating. So we'll keep watching it closely.
So, yeah, despite all the predictions that we're seeing on TikTok, on the media, that the housing market is about to take off on these new regulations, our central bank says that it could go one way or the other. The central bank isn't sure, or at least if it is, it isn't saying. And then, speaking of the housing market, we got a really good question coming from the Financial Post.
Curious how much the bank factors in bond market expectations. So, for example, yields are up today despite the 50 basis point rate cut. Seems the market doesn't really believe we need much more rate cuts than are already priced in. So, if yields were to start marching higher, maybe with U.S. yields going up, how much would that market outlook affect your expectation of how much more easing we need here in Canada?
Well,
and yeah, that's a good question. As we discussed earlier, the bank just cut rates by 50 basis points, but we barely saw a change in bond yields, meaning no change to fixed mortgage rates. As we'll see, take a look, notice how the governor does not disagree with the mechanics.
And yes, we look at financial conditions when we're taking our decisions, because people don't fund their mortgage at our overnight rate. They fund their mortgage at their mortgage rate, which could be a variable rate, it could be a 5-year rate. If you're a business, you're not borrowing money overnight at the Bank of Canada rate. You're paying the prime rate. You're probably borrowing for a few years. So yes, we do look at the rates that businesses and households are actually facing. That's a key ingredient to broader financial conditions, and that's something we look at when we take our interest rate decisions.
So, what the governor is saying is that while bond yields could remain high despite the Bank of Canada cutting rates, meaning fixed mortgage rates could remain high despite the Bank of Canada cutting rates, if that were to occur, then the bank would have to take that into consideration. Meaning, we could see a far lower policy rate in order to offset the higher fixed mortgage rates, which, as we've all seen, always turns out well forever. So, the Bank of Canada did cut rates by 50 basis points, and at the press conference, we did get our usual laughable nonsense coming from Canada's media elite, but we also did get a couple of good questions. First, on the new mortgage rules and whether or not the bank thinks they will be enough to push up house prices. And second, and I think more importantly, on the bank needing to compensate if U.S. yields remain high. if Canada's bond yields remain high, and therefore our fixed mortgage rates remain elevated despite work being done by our own central bank, something we've discussed so many times at great length on this channel. As we've discussed before, whether or not those fixed mortgage rates will remain elevated remains to be seen and will be largely based on what comes out of the United States, but we'll obviously continue to track Canada's rates on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.